Welcome, and thanks for joining me for today's live strategy session. For the what we're going to be doing today, we're going to be going over the ASX 200, have a look at the small ordinaries, and also going to have a look at some of those commodities: gold, copper, uranium. Some interesting things going on there. So yeah, look, hopefully that's going to be an interesting show to cover today. As always, everything is general commentary, no personal advice given in this. It's all general of nature, and you need to go and get your own personal advice for anything you're unsure of. I'm just going to put the quick disclaimer on since this is since we're doing live. And yeah, look, it just says all that, or what I just went through then, that this is all general commentary only. Okay, well, with that said, I think it should be it's time to get into that first chart. So here we go. So I've got the ASX 200 up on the screen, and really it's been quite a subdued week after those big declines that we had in the previous week. But look, having said that, I think really you've got to say that the technical situation does remain weak. And it's interesting though that the ASX 200 has it's held in fairly well this week, considering the falls we've seen in the US in the last week. I think from a short-term basis, the market's probably getting quite oversold at current levels. And I think that opens the possibility of some sort of a bounce, maybe over the next maybe the next week, maybe the next couple of weeks. We have to wait and see. There's no guarantee of that, of course, but it's also like you also note how far stretched this market is beneath those moving averages. And as I say, it hasn't sold off with the US market this week. So maybe that suggests there's some sort of a temporary low trying to be formed around current levels. There is overhead resistance coming in just above the market at around 6,870-ish. But I think it's also interesting to look at, I'm going to put some Fibonacci's on. Have a look at that, because they're always interesting in terms of when we're talking about like where a market could rebound to or pull back to. The Fibonacci's can be quite useful. So using the high from mid-October to the recent low, you can see the shaded area. That would be the Fibonacci retrace potential if this were to be an ongoing decline. A bounce back into the Fibonacci region, let these moving averages continue to come lower, catch up, and then we look at like what does the structure look like from there? Does it look like maybe there is some more of a lasting low in place that we can look for, maybe a more lasting break to the top side, or is it just going to be that return to the averages and then lower again? So we'll see how that price action plays out over the next week. This isn't something I want to trade. I don't want to buy this dip. I don't know how far it may bounce, but it's not something that I want to buy. It's overall, I think we've got to say that the momentum is still clearly to the downside. Just from that July low, that's the path we're currently taking is very much to the downside. The key features on this chart, well, for me, they remain these declining moving averages. Just looking at the 50-day and the 100-day moving averages, they're both heading lower. And whilst that remains the case, it's just a market for extreme caution. We've also got that series of lower lows, which has been continuing to develop, and lower highs. So they're your classic ingredients for a downtrend. For me, the strategy, it really hasn't changed since what I was telling you last week and the week before that, and so on. It's a case for me of exiting stocks as they're hitting their exit stops that I have on all my positions. And I also haven't been in a hurry to buy. I haven't been in a hurry to buy since particularly since these moving averages cross and we got the breakout from this 5-month trading range. And that breakdown was back in was about a month ago now. Back around the 20th of September, we got the break from the 5-month trading range. So that's when the red flags went up to say, look, this market has the potential to trade lower. So, and that's pretty much what we've seen. I think looking at my own portfolio, it's lost ground. It's lost ground over this last few months. But I think when the market does this, it's inevitable. It's inevitable. Our portfolios are going to give ground. There's no way around that. The only way around that, of course, is not to be in the market. So we've got to expect that we're going to take portfolio damage when the market declines. That's where risk management is so important. It's about like knowing where your exit levels are. And when you do see those red flags come up, that it's about keeping risk contained and not buying shares that are falling and getting out of the ones which are falling too far. And so much of the losses to my portfolio has really been giving back previous gains. There has been some losses from stocks I bought which have just gone down, but much of the loss has been giving back of gains. No one likes to give back gains, but the only way to stay on larger moves is to risk giving back some sort of gain to try and stay on those moves. And as I told you last week, for me, it's about also having higher cash levels at this time. What's been interesting through the week, I was watching the ABC News earlier in the week, and yet again, I've seen another comparison to the 1987 crash. Came up on the screen. It was they said, "Hey, look at this. There's this likening to what we saw in 1987," and it really is interesting to me. It's I'm going to compress this chart. Just going to give you. Let's go back to. Actually, I'm not going to use that because that's the ASX 200. It doesn't go back to 87. I'm going to click over to the All Ordinaries, and it's on a weekly chart. Just going to compress this, get ourselves back to 1987. Now, this is 1987, October 87. That is the October crash. And the market had been rising almost in a parabolic nature throughout the year before it got to this point where it just started to come apart. Remember, this is a weekly, so it didn't happen in the case of 2 days. It was like 1 to 3 weeks of declining action, and then we had a swift fall. So it wasn't something which just happened overnight. It did start to decline in the weeks ahead. But now, remember this, and now let's go to present time. To me, this chart looks nothing like October 87. I think an event like October 87, whilst the market is declining, whilst there's risk of it continuing to decline, I think the risk of a 1987 style crash it's just extremely low. And the thing with crashes happen when pretty much nobody's looking for them. When you're seeing it on the nightly news, I don't know. For me, I don't think that's a scenario we're playing for. But nonetheless, it is still a time that we're managing risk. Also, have a look at this. This is the Beta Shares ASX 200 financial ETF that I've been showing you over the last. I think I showed it last week, and I'll just go back to the daily chart. What we've seen through the week is. Last week I was talking about we're in the middle of this range. You can see this range the market has been in over the last 3 months. I was talking about being within this range, and whilst that remained intact, we still had this sequence of where you can see these blue lines. We had this sequence of rising lows. This week we've severed that sequence with the market breaking below the low points from October and August. Moving averages are also starting to cross and turn to the downside. So it just adds to that. It just adds another reason, I think, to tread carefully and keep a rein on risk until we see some more constructive price action start to develop. I don't know how far this is going to decline, whether it can stabilize sometime soon or whether it does continuing to pull away. But again, I don't see this as a crash style setup. Well, at least not for now. But it does remain a weak market, a market which remains vulnerable to further downside. Let's have a look. Having had a look at that, let's jump over to the small ords and just have a look at that. because this has been, while the ASX 200 has held up reasonably well during the week, same can't be said for the Small Ords, which has fallen. It's made a new low for this sell cycle and is now testing the low from over here in October last year. It's generally been weakening below these declining moving average since you can go back to early September, where we started to see the market start to weaken below the averages. Then we got the breakdown from the trading range. You can see by those blue bounded lines. We've got the breakdown from there in towards the end of September, and it's been a continued case of this market giving ground. But it is something we've spoken about. We've spoken about the potential for this to continue weakening for some time. So from that respect, it's not a great surprise to see it at lower levels. It's disappointing that I had hoped that maybe it'd find support and be able to make some sort of sustained recovery, but it hasn't. The rallies just haven't been able to gain traction for some time. So we've got that continuing weakness in the market. I don't want to preempt the low here. I think it's a case of waiting for the price action to tell us when the time is to step in and take on some risk in this part of the market. I think the path of least resistance is lower, whether we like it or not. That's just the current state of play. But I will say this though, if you can say one good thing about bear markets is that they do end and they ultimately lead to new trends from lower levels. And I can't see why this bear market is going to be anything worse than or any different. I don't see why this could be any different to previous bear markets. They do end and they do lead to those new trends from lower levels. And I think the key for coming through this period, as difficult and as unpleasant as it's been pretty much for 2 years now, it's to keep those losses to a minimum, to protect capital. Yes, there are going to be losses. Profits are going to be given back. There will be new losses in breakouts that fail. But just keeping risk at a lower level and seeing this time off and waiting for those better times. And if you can do that, if you can protect that capital, both your financial capital and also your mental capital, just by not getting beaten up every day, then hopefully you're ready for when times do inevitably turn, which they pretty much always have. And now, look, if you're getting some value from this, please hit that like button. If you're watching the live strategy session as we are now, you can't leave a comment in the usual YouTube section. But if you're watching the replay, you can. So please leave that comment and let me know what you think, whether you like what I'm doing, or just thanks for the video. That's really appreciated, and it tells YouTube that you're watching and you're engaging. Now let's jump over and talk a bit about commodities. So let's start with gold, because interesting week in gold. It seems that to me that gold is starting to lose a bit of its momentum. Maybe it's starting to stall after this exceptionally strong run we've had off the October low. And I said last week that I thought that some sort of move back towards the moving averages was likely, and that remains the case. It's just one of those technical structures you often see where a market runs hard through the averages and then it comes back and retests them. I think there's a good chance. I think there's a strong chance we're going to see that with gold. I'll put some Fibonacci's on. They're interesting to consider as well. So let's use the low point from October, the recent high, and you can see where the shaded area is. It comes back in around where those moving averages are, and it does seem a long way off, and it can be sometimes hard to imagine could a market pull back, which is like up near its recent highs. Could it pull back so far? And the answer is yes. Markets often do that. Like, just look at this period back here in February. The market had been strong, and just see what happens here. Let's just put a Fibonacci on from that November low to the high. And yeah, there you go. It comes back within that Fibonacci region, which is interesting. So you'd said to someone back in late January that the market could pull back what would have seemed like a fair distance, it might have seemed, look, I don't know, that seems like a long way, but sure enough, that's what happened. Now, it doesn't guarantee that gold's going to do that this time by any stretch. For all I know, it continues rising, and we're testing this big resistance within a week or two. But yeah, I just don't think this is an asymmetric point to be entering. It's very much a market that I like and that I have positions in, and that I'm continuing to hold those positions in. So don't get me wrong by saying that it's not an asymmetric entry point. I think it's certainly a point to be holding gold positions, but I'm just wary of that potential for a pullback towards those averages. And if we get that, and it's always an if we get that, that could potentially set up an excellent entry level if we got some consolidation and then we started to get some strength out of that. I'm continuing to watch those gold stocks as well. And I was having a look at Newmont a little bit earlier. And it's interesting in that I wonder whether this could be the early stages of a basing structure in Newmont. So just compressing this for a bit. And you can see Newmont's had a pretty torrid time since April last year, and that's pretty commonplace amongst the gold sector generally. It's been a bit of a washout for many stocks in the gold sector. But just looking at the recent price action, we had this sharp decline in September. We've got the V-shaped rebound back to the moving averages. Now we're sealing off again from the averages, but so far that's we haven't broken below the October low. So what I'm looking for here, can the price stabilize around current levels? If gold stocks and Newmont in this particular example, if they can sort of stabilize somewhere around current levels, then it opens up the potential for a rally out of a basing structure. And it's a little bit early to say, but there's always the potential makings of a head and shoulders formation here. Like you get the left shoulder, you get the head. Could we trace out a right shoulder over the next few weeks? And then if something like that happened, then you get a potential neckline, a potential breakout. Yeah, it's too early to be calling that because we haven't seen it. But they're just the sort of things that I look out for and the sort of possibilities that can form. So interesting to watch Newmont, gold sector generally. Can we get some sort of base here? Also a bit of resistance to keep an eye on. It's around just having a look through here, these low points. I think we draw something through here at around 40. Yeah, you can see we've got so this is really the area to watch in Newmont. And Newmont's really the leader for the gold sector. You can see it picks up these low points from 2022, more low points earlier in this year, and then the current highs as old support now becomes resistance. Now we're on the other side of it. So interesting stock. Keep an eye on Newmont, and that would be a break above 40. It'd be a really good step in the right direction. Still need to wait for these moving averages to cross, and they're going to take a bit of time. It's not something which is going to happen over the next couple of weeks. Being 50 and 100-day averages takes time for the old data to drop off, new data to come in, and that's if prices start to turn up. So I don't think this is a trade for next week, but it's starting to structure. And as I said, I'm happy to keep holding my longer term positions in gold, and I'm watching for new opportunities. Now, let's jump over to copper stocks. So I won't look at the metal today. I'm going to look at the actual stock. So this is the Global X Copper Miners ETF. I'm using the US listing because it's got more data. There is a local listing, WIRE, WIRE. This is the local listing, but you can see why I don't use it. It only started trading in late 22, so it doesn't have the same sort of data. So I like to go off the US listing. And when we look at this, we've got this breakdown which is happening. So we've had this big 9-month trading range. You can see it's bounded by those blue resistance at the top and then support down beneath. And just in the last week, we've started to break down below this lower support. And we've also got a sequence of lower highs and lower lows. So it remains a structurally weak market below these declining moving averages as well. Looks like it's trying to hold some sort of hold its ground a little bit over the last few days. Maybe there's some sort of return move back towards resistance at this old support region, back towards the moving averages. But the path of least resistance is down. I think copper's got this great longer-term story, and I've been watching it for ages. Like, we had the big move during 2020, and then after that peaked, it was like, when's the next buying opportunity in copper stocks going to be? But this has taken, well, it's been 2 years, over 2 years of this large sideways type of price action, and it's still showing signs of weakness. So I think it's a case that it's a great story, but I think we just got to wait until the price action agrees, and it's a case of watching and waiting. The market will work on its time frame, not on ours. And just lastly, I want to have a quick look at uranium, and this is an interesting one. So uranium's made another new high during the week, so that takes the total gain from, go back to this low about 3 months ago. That's a 57% move in under 3 months. So that's really extraordinary to get that sort of move. But look, that's what we have. That's what can happen when you get the pent up energy from these large trading ranges. When they break, they can lead to quite quick and significant gains. What I'm finding interesting is, though, what I want to do, I'm going to overlay this with a chart of one of the big copper stocks, not copper stocks, uranium stocks. I'm going to use CCJ, which is Cameco. This is a US listing of Cameco, so this is the big Canadian uranium stock. And so Cameco's in the orange, and uranium is in the bar chart format. So let me just move these around a little bit so we get a good view of them. And what I notice when I look at this chart is divergence. So we have copper making new high, but then you look over at Cameco, and Cameco is typical of the uranium space generally, the uranium stocks. The uranium stocks aren't following the metal higher. So what does that mean? What that means to me is that this doesn't seem like an asymmetric entry point into copper stocks. So one, we've had a really big move already, and two, we've got divergence with the metal. Often they move, you just look back over the course of this chart, and often they move together. You don't usually get that type of divergence. I like this as a longer to like a medium to longer term play. I haven't sold any of my uranium stocks, and I'm hoping to stay with a larger medium term trend. But my take on this in the near term is that I think there's consolidation coming. It's been a big run, 57% in 3 months. I think that's a really sizable run. I think some sort of pause is necessary. Maybe uranium can come back towards these averages again. Maybe these copper stocks are going to do some work. So I'm not keen to add to my holdings at current levels. I like the uranium space, but I don't want to chase stocks when we're seeing that sort of price divergence creep in. So what I'd normally do now, I'd show you a couple of interesting stocks which have turned up in the motion trader signals, but I'm not going to do that this week because of what I've been talking about in terms of like how how these markets are trending, looking at the small ordinaries and looking at the ASX 200. It's just not the sort of environment where when I talk about stocks, I want to talk about stocks that I think are have the potential to do something interesting in the near term. I don't want to talk about stuff just for the sake of saying, hey, each week I'll give you 2 stocks. It's not a quota system. It's an opportunity-based analysis. So if I don't see it, I don't want to talk about it. There are a few interesting things I thought of talking about, but the liquidity in them was too low. They go out as motion trader signals and members can make their own decisions, but I don't want to talk about low liquidity stocks in a video strategy type environment. So I'm going to leave that for this week, and we're going to go straight over to the Q&A. And there are a few stocks which are appearing in the Q&A, so we'll go through that. So AZS is the first one I've got here. how do we pronounce that? Azura Minerals. And this has just got another takeover offer. It's a lithium play, if I'm correct, and it got another takeover offer recently. Look, something like this, I'd be holding my position. There's no reason. I would see no reason to sell. Like, of course, the risk always is that the takeover disappears, but yeah, I'd be probably selling into the takeover. That uptrend remains in place, and it's just testament to the power of staying with trends. And you look at where this originated from. Moving average cross back in November 22, but it didn't. So what I use, I couple a moving average cross with a break to a 70-day high, and that never happened on this occasion. So this isn't a moving average cross which I would have acted on. Market pulled back again, had another break higher, moving averages crossed. That probably would have been a 70-day buy trigger in June 23. If not there, it would have been in April 23. And then this has been a great run. It's staying with the trend. There's been no reason through this whole rising period to exit if you're using a wide trailing stop. You can sit through these pullbacks. This was relatively deep, but given the volatility of the stock, a wide trailing stop may have seen it off, or it may not have. I can't be sure, but it's been a good example of staying with winning stocks, because that's where the big money's made. It's not by making, you look over here. It's not by getting in at 35 cents and going, oh look, I'm double money. I'm going to take profit. It's let it run, because these things can run for a very long way. That's where the big money's made, by letting them run. Been asked about IVZ. Now, Invictus Energy, I suspect that is. And the question is it pushing higher? And look, it does look to be pushing higher. We've got the moving average cross, and we've got the break to a new high. So they're the initial criteria that I'll look for. It's had a pullback towards the averages, got a little bit below there. Depends how you play it. Like if you like using a tight initial stop, this pullback would have been enough potentially to have taken you out. And then you think, well, now what do I do when it regains momentum? You think, well, do you get back in, put a new stop? That's probably the disadvantage of relatively close stops, is you get more whipsaw. You're going to be in and out more often. If you set a wider initial stop, like I do at the Motion Trader Surface, you can often see off these initial pullbacks and stay with it when they run. What it's doing now, it's doing well in a difficult environment is probably another point to make. I wonder whether this is somewhat news related as well, because we've had a gap higher during a period where the market's been coming off. But at this point, we've got a stock which is increasing, moving averages are rising, so it's got potential. It's got potential to continue running. Whether it continues to run or not, I don't know, but it's got the upward momentum and the potential to go higher. I'm going to have a look at CSL. So coming across to CSL, and look, this is in a steep decline, and it's been in declining mode since these averages crossed back in June. That's when it would have come off the radar as a stock I would have been considering. Like as it was rising above these averages, it's a stock I'd consider. But as soon as the averages cross and the share price is below, it comes off the radar. Interesting to see this price action that we got during July. When you get a market that's falling below averages and then you get the shallow bounce, you'll often hear me talk about a shallow bounce. And this is an example of a shallow bounce where you've had a steep fall, a shallow bounce back to the declining moving averages. It always remains a point of vulnerability. So some people will look at this and say, oh, well, look, the low's in, maybe it's time to buy, but it's still below declining moving averages. So you always run the risk that the decline's going to reassert itself in a strong manner, which is very much what has happened in CSL. Very much the potential for a short-term bounce because it is stretched below those averages. But I don't want to play short-term bounces. Like, look how this short-term bounce worked out. It bounced for a couple of weeks and then continued to decline. So I'm not going to try and pick the low in a stock because it's just too hard. You don't know how long a stock's going to decline for. Like CSL is the top tier stock, but could it continue to unravel over the next year? It could. No one can say that it won't. So buying the dip, it's not a play I want to do. It's also notable that it's breaking down from a large range. So if we put that across here, you can see it's like this is a big trading range which has been in for some 3 or so years, and now we're at the lower end of it. Oh, well, actually, we're underneath it. So there's risk with CSL. Can it continue to fall? It's definitely got that potential. I'm not interested until it can start to show some stability, start to rise, get above these averages, and then have the averages start to turn higher. Until then, it's for me, it's an avoid. Nickel. I'll see whether I can get nickel. I don't know that I can. What's that? Just looking at the options that I get down here. Nickel, maybe this will work. So presumably this is the nickel price, and it's downtrend. And this is the interesting thing with gold, because it's not a broad-based commodities bull market at the moment. A lot of commodities don't look so flash, and nickel's an example. It's there's nothing bullish about this chart, nothing whatsoever. It's declining below the moving averages. It's making new lows. It's just one to step aside from and wait. And you go, oh look, some people are always tempted. Oh look, it's come down so far. It's got a base soon. But you could have said that in August. You could have said that in June. You could have said that in early June. You could have said that in March, and so on. Trying to pick the low. It's just you often find yourself getting into something which continues to deteriorate. So nickel's one which I'd leave alone. Pilbara Mines, which is PLS, I believe. Yep, Pilbara Mines. And Pinra Minerals. It's interesting so if you're going to look at like your classic support areas, you'd probably say there's going to be support coming in around where the market is now. And we could probably pull this across a bit further. No, I probably can't really use that. But there's support. There's going to be support here. And then you look at like how a correction can play out. Like, could this be like a zigzag correction where you get your classic ABC type correction back to a support? If it's an ABC type correction, sometimes they go a little bit further. They pull back below support, then start to base, and then start to rally. That's just some technical structure. Something similar happened back here in 2022. Got the zigzag correction. This could be part of that sort of structure. The problem I have with it is that it's below declining moving averages. So I don't want to play that. Some people would. Some people would say, look, I'm going to buy it at current levels and I'm going to put an exit stop just below the market. They'd say, like, if someone really liked Pilbara Minerals, they were into the fundamentals of it, they believed in the story, they thought it was good value, they might buy it at current levels and put, maybe they've got to put a 20% stop on it. I don't like this strategy. I'm not suggesting anyone do this strategy, but this is a strategy which people who like to buy on support may play. I don't mind buying on support when a market's coming back towards the moving averages. Maybe I'd consider doing that because the overall direction of the trend is still up. But here we've got a market which is declining below moving averages in a pretty risk-off type of environment. So I'd like to leave it. I'd watch it. If it starts to base and consolidate, the moving averages start to turn, then I'll look at a possible entry at a higher level. But I'd rather buy this a bit higher than so just think about it. So say you bought it here and you put on a 20% stop. Why not wait and buy it? Maybe you buy it 20% higher. Instead of risking 20%, see if it consolidates, see if it breaks out, buy with momentum and pay an extra 20%. Maybe that's better than risking 20% in a stock which is currently falling in a pretty ordinary type of environment. So just a strategy to think of. SSM, Service Stream. I know this stock. I think I've got this stock in my own portfolio. It's moving averages crossed back in June. Can't remember where my entry is. I can't remember. It's probably somewhere around July where I'm in. It's look, it's an interesting stock. It's come from great heights. So it's certainly one of those down and out stocks, and it's got the potential. Like, is this some sort of like, a rounding basing structure? We had the same sort of potential in 2021, 22, and it looked like it was starting to break up, but then failed and continued lower. And this is always the thing to remember when you're looking at trying to use price action to time your entries. The setups don't always work. So this possible setup that we had in 2021, 2022, it didn't work. This breakout didn't run. Now here we are again, potential for another turnaround. It's in my portfolio, but I won't hesitate to cut it if it starts to climb below these averages and come back to my exit stop. I use a 60-day time exit. So if I was in, say I was in June, which I don't remember, I was in late June, 60 trading days is probably going to get me out. So I won't have much risk on this stock now. I'll end up getting out potentially close to my entry level on a pullback below these averages. But at the moment, I'm happy to give it the benefit of the doubt. It's holding in reasonably well in difficult conditions. It's always got that potential to continue upwards from here. MRM is Mermaid Marine, and I know that because it's MMA Offshore. I think Mermaid Marine was its old name. MMA Offshore is a new name, and I've got this one as well. This is one of my better performing stocks. I've had this one for a while. I think it's in my might be my top 4 best performers. Upward trends in place. This is one of the few ASX stocks where you can say the upward trend is in place. It's pulled back to the moving averages, and you can see it's done that several times. It's pulled back to these average on a number of times during this upward sequence, which began when the moving averages first turned to the upside back in February last year. And it's been a case of the market runs, then it pulls back towards the averages. It's not always nice and neat. Sometimes it'll go through those averages, but most things aren't nice and neat. It's but with a wide trailing stop, which I use with the Motion Trader service. As you'd know if you're with the Motion Trader service, we've been able to see off all these pullbacks along the way. None of these pullbacks have been enough to trigger the trailing stop. I don't know where the trailing stop is off the top of my head, but it's enough to currently be seeing this pullback off. Whether this is the one which continues lower, we don't know. But at this stage, I'd be happy to hold this. It's come back to the averages. It's holding up well compared to the broader market. It still has the potential to rally off there and continue upwards. Or like we saw in March, April, May, sideways consolidation was also a possibility. So yeah, various possibilities there. But I think overall, trend is up. EML, that's one we spoke about, I think last week. And let me just grab that. And so yeah, so last week I was talking about as one of my stocks of interest. It turned up in the Motion Trader signals, and it had a strong rally, a sideways consolidation, pulling back to the averages, kind of price action which we saw on that MMA just a moment ago. But look, you've got to remember, this is a really difficult market. It's a volatile market, and not much is going up. Quite a wide range day yesterday. There definitely seems to be buying, which is so far underpinning the stock. Whether that will remain the case is yet to be seen. But it's a stock which are one of the better looking chart structures at the moment. This is a stock I'd consider. Look, I'd consider this stock. I'd probably want to buy it in the current climate. I'd probably want to buy it on a breakout. So, like, I might look at these previous highs from the last few weeks. Maybe broke above. Like, what's that? 122. Got above there. Maybe it was a buy, or you could use these other highs which are a few cents higher. But I'd probably want to buy into some sort of upward momentum rather than just buying at the moment, because maybe it does start to ebb away like the broader market has been doing. but does look constructive. And MQG, so that would be Macquarie Group, I think. And yep, Macquarie Group. And someone asked me the other day, they said, why aren't you talking about big cap stocks more? And the reason I'm not is because a lot of them look like Macquarie Group in that they're trading below these declining moving averages. And this is where I think the risk to the broader market is. Some of these larger cap stocks, like we looked at CSL, it's breaking down from a 3-year range. Look at Macquarie Group. Moving averages crossed in July. That's when I think around when the ASX 200 averages started to cross. All the rebounds have been back to declining averages. Has these rebounds back to declining averages. And now we've got another shallow bounce, and it looks like it wants to sell off again. Just compress this a little bit more to get a larger feel. Like there's no reason for me here to want to buy this. I'm pretty sure it won't be. I'm pretty sure it's not a motion trader stock at this point in time. Maybe it is. I'm not sure. Could have actually triggered a signal up here, in which case it'll be closing in on its stop loss. It's certainly not a stock I'd be buying. If I had it and I had a wide initial stop on it, I might give it a little bit more room. But it's a weak structure, and it's at this stage not looking like it looks like the path of least resistance is lower. Have a look at. We'll wrap up in a sec, I think. And ORA, we might make this the last one. Oh, clicked on the wrong ORA. There we go. There's the ASX one, and it's look. It showed it would look like it was doing something interesting just recently. It was breaking higher above these rising moving averages. This looks like a news event. Something's happened. It's been some sort of company announcements, whether it's a profit downgrade or I don't know what it was, but it's fallen away. There's no reason I'd want to buy it at this point. I'd be if I had it, I'd be looking at my exit levels and working out where I was going to probably exit it. And this is going to happen. There are always going to be times when you get breakouts that then for whatever reason fail. So this is why it's sort of like it's a numbers game. It's for me, it's a case of many relatively small trades. I want to play lots of breakouts because I don't know which ones are going to be like MMA, which run a long way, or what was it, Azure Minerals earlier on that we looked at, stocks like that, which run a phenomenally long way. We don't know which ones are going to be. So we're also going to accept that some of the breakouts are going to end up like Aura and just fall away. So that's just that's part of the game, and it's going to be more likely when we're in conditions like we currently are. So it's about managing risk, making sure when these happen, it's not like a 2-stock portfolio. So this is a disaster. If it's part of a 10 or a 20 or a 30 or more stock portfolio, it's a relatively it's a frustrating but a relatively uneventful event. So look, I think we might call that a wrap. So there we go. So look, thank you for joining me. Hopefully that's been interesting in this tough environment that we're currently in. We are going to come through it at some point, but we just don't know when it's going to be. Whether it be a case of weeks or months, or it's wait for the price action. Wait for the price action to give us something to go off, which is encouraging. At the moment, we don't have that. It's a case of hoping the market's going to base rather than having something to say, look, we've got a bit of a basing structure. We've got some momentum. We're starting to get above the averages. That will happen. We just don't know when. So look, thank you for joining me. It's been great talking to you, and I'll look forward to coming back, talking to you next week. Till then, bye for now.